Welcome back to the Brent Daily, where we are paying attention to and reporting on what is happening in the home loan interest rate world and why that is happening, what is causing those movements. Today is October the 6th, 2022. It is now 11:22 a.m. Central Time, a little bit earlier than I usually report, but I have some meetings I'm going to this afternoon, so I wanted to make sure to get this information to you. There's two things that we are watching and hearing today. First of all, we talked about yesterday that OPEC, so the entity that kind of manages overall oil production globally, was saying that they were going to cut about 2 million barrels a day. If you cut oil production, that usually causes a reduction in our inventories, which causes an increase in gasoline prices. Well, the Biden administration in the United States had been using some of its strategic reserves to try to offset that. Now, we heard today that the administration has decided to extend the use of our strategic reserves to try to continue to offset the reduction in oil production by OPEC in order to keep prices down and help the American population dealing with the inflation that we've been seeing. Well, at this point, you have to understand, we're glad that that they're trying to help out, but there's only so much oil in our strategic reserves. And think about it, it's a strategic reserves. It's not an inflation resistance reserve. It's for major issues. I mean, what about war or something that cuts off our oil production entirely? We are at this point at the lowest levels in our strategic reserves since 1982. And we're using that oil to help keep oil prices down. I don't know if really that is the best use of our strategic reserves, but that is some news of today. The other thing that we're watching is employment numbers. The Federal Reserve has two basic mandates that they're paying attention to. It is number one, inflation, keeping pricing under control. And number two, it's employment. So their job is also to do all that they can to create maximum employment. Well, let's take a look here. Whenever you're trying to do those two things, it becomes very difficult because you're trying to slow the economy, but keep everybody employed. Well, if you're slowing the economy, then that slows the need for products and services. So all of a sudden, we don't need as much, of the ancillary products because people start saying, "Ooh, I don't know if I can buy those extras." So you reduce the need for these extra items, those things that we just don't truly need in our life. And those companies have less sales, which trickles down to saying, hey, look, we don't need that many people anymore. Okay, so they end up laying people off. And we're starting to kind of see that a little bit here. Like, for instance, Peloton is a great one to look at. So back because of COVID and everyone having to stay home, you've got a situation where Peloton was tremendously popular. You all remember that, people buying Peloton bikes and exercise equipment and weights and all this and that because people were stuck at home and wanted to exercise. Well, that's great for Peloton. They had some great years, but now they're having to slash jobs because it's not quite the buzz that it was. Things are slowing and they don't need quite as many people. That is an effect or an example of a slowing in a specific sector. And the Federal Reserve is trying to slow basically all sectors. So we got to watch out for job losses because job losses, again, push us further into a recession. Less people have jobs, less people have money, less people can spend money. And all of a sudden, it starts to kind of come down on top of itself. Well, how are the home loan interest rates responding to this news as of today? Currently, we're down 37 basis points. Not really liking what we're seeing. The 10-year Treasury is up 5. We're moving towards that 4.0 that we do not want to be up against. So let's go down here, look at our charts. This is the 10-year. We're looking for something that's going to stop us and push us in the other direction. Well, we've broken through this ceiling of resistance, and now we're up here where we have all this room to run before we hit another ceiling. That is not what we want. All the way up to 4.0, which is where we all know we don't want to be at 4.0 because that was when we were pushing up against 7% on the Brent daily interest rate, which is really not where we want to be. So the mortgage-backed security world, let's look at that chart right quick and we'll get over to the interest rates. The mortgage-backed security chart also does not have a very strong floor to actually support us until we get all the way down here to 97.02. And we're at this point at 97.67. So that's a long way to go. Not a lot of support in front of us. So we are kind of in a position where people are recommending locking interest rates ahead of tomorrow's job numbers because we're going to get some job numbers that are going to come out. Here's the Brent Bruce Daily scenario. Let's take a look at see how interest rates are looking as of today. Let's open up our image here to show you what the parameters are of the Brent Bruce Daily. Just one moment here. All right, modify search. This is the parameters. If you need to screenshot that in order for compliance, let's go ahead and run it, see where we are. Basically, you can see that we're at 6.75% currently on the Brent Bruce Daily with no points, actually a little bit of a credit of $436. If we open this up, let's take a look and see what we could do. If we wanted to spend a point, we could get to 6.375, all right? So we did tick up about 1/8% today based on the numbers that we're seeing. We'll have to see how these employment numbers come out. Unfortunately, a lot of people are expecting things to get a little bit worse tomorrow as far as the interest rates, but we really want to make sure that we don't go into that 7% range, which is kind of that ceiling that I've said that we would not be breaching here. We will take a look and see. Thank you for watching. Make sure that you like, subscribe, and share. Have a great day, and I will get back to you tomorrow and let you know how those employment numbers come out and how that is affecting our home loan interest rates. Have a good day.